This episode of The Riffle is brought to you by 10 Leaves. Welcome back to the deep dive. Today, we are looking at a massive regulatory overhaul happening in one of the world's most dynamic financial hubs. I'm talking about the Abu Dhabi Global Market, or ADGM. The Financial Services Regulatory Authority, the FSRA, is celebrating its 10th anniversary, and it seems their idea of a party is a complete regulatory reboot aimed squarely at global competitiveness. We're basing this deep dive on their consultation paper number 13 of 2025, which is all about the insurance sector. Okay, let's unpack this, because this isn't just about insurance. This is really the final piece of a year-long puzzle. The FSRA's mission here is to align its entire framework with the world's top regulators. They already tackled banking standards earlier in 2025 and securities rules back in October. This insurance review is the last leg of that trifecta.
Exactly. And what's really critical here is how it all comes together. This one paper hits 5 major areas at once. It's strengthening rules for reinsurance and for conduct. It's mandating the new IFRS 17 accounting standard. It's formalizing how firms deal with climate risk. And, maybe most importantly, it's laying the groundwork to position ADGM as a major international reinsurance hub.
So what here is pretty big.
It's huge. ADGM is basically sending up a flare, saying its regulatory environment is now on par with London, Singapore, or Hong Kong. It's a strategic play to attract those huge, globally active firms that just need predictability.
So they're signaling serious ambition.
Immediate ambition.
Let's jump straight into that then, starting with the foundation of it all, the IAIS principles. The first big piece they're tackling is reinsurance, which is IAIS Core Principle 13. This basically demands that insurers, even smaller captive insurers, have to properly manage the risk they're passing on to a reinsurer.
Right. Think of reinsurance as the shock absorber for an insurance company. But, it also introduces a new risk. What if the reinsurer fails?
The counterparty risk.
Exactly. If your shock absorber breaks, you're in real trouble. So the FSRA is really beefing up its rules here to bulletproof that entire process.
And how are they making it bulletproof? What specific controls are they putting in place that maybe weren't there before?
Well, they're dramatically enhancing the due diligence requirements. First, they're adding really detailed guidance on how a firm selects a reinsurer. It can't just be an assumption of quality. It has to be a documented, structured evaluation of their actual creditworthiness and capability.
Okay, so more paperwork, but for a good reason.
And second, they're mandating new systems for reporting and monitoring claims under those reinsurance contracts. They want to make sure the process for getting paid is being tracked properly.
And what about the worst-case scenario? The systemic risk, if one of the parties just goes insolvent?
That's precisely what they're targeting. The new rules require an insurer's own risk management system to specifically model what happens if either the insurer or the reinsurer goes bust.
So you have to know where the money stops.
You need to know exactly where the cash flows stop and where protection remains, even under, extreme financial stress.
The paper also touches on special purpose vehicles, or ISPVs. These are often used to securitize specific insurance risks, right?
Yes, an ISPV is basically a legal risk bucket that isolates one particular exposure. To make sure that separation is real, the new amendments state very clearly that investors who put money into that ISPV cannot go after the original insurer if they lose money.
So the risk stays in the bucket.
It legally reinforces that isolation principle. It clarifies exactly who bears the loss when things go wrong.
Okay, so that locks down the structural risk. Let's pivot to the customer. The paper also goes after market conduct, which is Core Principle 19. This one requires everyone, insurers, intermediaries, to treat customers fairly.
And this is where you can really see the forward-looking strategy. ADGM, until now, has been mostly a wholesale market, big banks, institutional clients. But to attract those massive, internationally active insurance groups, IAIGs, which often have huge retail businesses,
they need the retail rules in place first.
Exactly. They need world-class conduct rules ready to go now. These changes are all about making ADGM IAIG ready.
That context is everything. So what are the big consumer protection proposals here? How will this change things for clients?
There are 4 major shifts. The first is what they call product governance. Insurers now have to design products only after rigorously thinking about the needs of their target customer. They have to assess suitability, the benefits, and check that the distribution model, the brokers they use, is actually appropriate for that client base.
So you can't design a super complex product and then sell it through an unsupervised channel.
Precisely. It puts the responsibility squarely on the manufacturer.
What about marketing?
That's the second one. fair promotion. The new rules say that if a firm finds out their marketing material is unclear or misleading, they don't just have to withdraw it. They have to actively notify anyone they know is relying on that bad information. And they're also proposing that firms get an independent review of their promotional materials.
A second pair of eyes. I like it.
Yeah, someone outside the marketing department.
A very practical protection. Now, let's get to the really critical part. Advice. How are they tightening the rules on the provision of advice?
It's all about transparency. Firms have to state very clearly if they are giving advice or just information. If they are advising, it has to be clear, accurate, and documented. But here's the real kicker for consumer protection. If they are not advising a retail client on, say, a long-term insurance product, they must formally recommend that the client get independent advice.
And what if the client says no?
Then they have to get a written acknowledgement from the client confirming they decline that recommendation. It really forces the issue of informed consent.
Wow, that puts the burden of proof right on the firm. What's the last piece of this puzzle?
Conflicts of interest. The rules say all firms have to identify, prevent, manage, and disclose conflicts to ensure fair treatment. But the bar is set very high by the final requirement. If a firm can't manage the conflict transparently, they have to decline to act for the client, full stop.
So they have to walk away from a potential sale because the conflict is too severe.
Yes.
That sounds great for the consumer, but is that a realistic expectation? I mean, doesn't that create a huge administrative headache for smaller firms?
It definitely forces a cultural shift. The FSRA is clearly prioritizing the integrity of the client relationship over just, transaction volume. It's a statement. It says if you can't manage the conflict, you don't do the business here. It sets that fiduciary expectation very, very high.
Okay, let's move into our second segment. We're shifting from governance to the bedrock of all this, data and transparency. The FSRA is mandating the adoption of IFRS 17. That's the new global accounting standard for insurance.
The aha moment here is just global consistency. The old standard, IFRS 4, was a bit loose. It allowed for a lot of inconsistencies in how insurers recognize profit. IFRS 17, which went live globally back on January 1, 2023, provides one set of uniform principles for everyone.
So why is ADGM doing this now, almost 2 years after the global date?
It's essential infrastructure if you want to attract those major international groups. Think about it. If a huge global insurer wants to set up an ADGM, they need to be able to consolidate their global books into one consistent set of financials. Adopting IFRS 17 just removes that friction.
So it's an accounting change, but really it's a strategic lure for big business.
Entirely.
That makes a lot of sense. Now, let's talk about the defining risk of our time. Climate-related financial risks, or CRFR. How is the FSRA telling firms to handle this?
They're taking a very pragmatic and proportionate approach. They're starting with some basic requirements that apply to all regulated firms in ADGM, not just insurers.
Okay, so what are the immediate steps everyone has to take?
It's a three-step process. First, every firm has to consider if climate risks, things like property damage from storms or, say, transition risks from new energy policies, are actually material to their business.
Step one is just think about it.
Right. And second, if they decide those risks are material, they have to understand and manage them in a way that's proportionate to their size and complexity. And third, they must factor the impact of those risks into their existing assessment of their capital adequacy.
So, for example, a property insurer on the coast would obviously see physical climate risk as material, and they'd have to build that into their capital models.
Exactly, but for, say, an asset manager, the material risk might be transition risk. The chance that their fossil fuel investments become stranded assets.
I see. So the FSRA isn't handing down one giant complicated rule for everyone.
No. They're demanding that firms use their existing risk management systems to figure out their own exposure first. It's really fascinating because it's so principles-based.
It's flexible. It recognizes that the data and the models for this stuff are still evolving.
Precisely. It's a smart entry point. It forces internal assessment before they start mandating costly, sweeping, quantitative rules. They're also proposing guidance on public disclosure for any risks a firm does deem material.
A very sophisticated first step. All right, let's wrap up with our final segment. Some administrative streamlining and the big strategic vision here. There were a few miscellaneous changes in the paper, right?
Yes, mostly just housekeeping stuff that makes life easier. First, they're simplifying client classification. In a reinsurance deal, the insurer and the broker will now automatically be treated as market counterparties.
And what does that do?
It eliminates the need for all the client classification paperwork for every single transaction. It just reduces friction.
Makes sense. And what about for captive insurers?
They're reducing the regulatory burden there. They're officially repealing the requirement for captives to file quarterly returns, unless the regulator specifically asks for them. It just codifies relief they were often granting anyway.
Okay, and the complaint process is changing too.
A small but important change. They're getting rid of complaints by email and moving everyone to a standardized online form. It's all about efficiency and better data tracking.
These small changes seem to point toward one big idea: establishing ADGM as a world-class reinsurance hub.
That is the big picture. This entire consultation paper is the groundwork for that strategy. The goal is explicit: to make ADGM a hub that can host the biggest global insurance groups, the IAIGs. And while this paper handles the immediate alignment on conduct and accounting, the FSRA is already signaling what's next. They're planning a future discussion paper.
What's on the horizon for that one?
That's where they'll get into the really heavy stuff. Sophisticated capital and solvency rules, comprehensive group supervision, what to do when a firm fails, and public disclosure rules that meet global standards.
So this isn't quiet compliance.
Not at all. This is ADGM planting a flag and explicitly saying they intend to build a best-in-class regulatory framework to lure those major players away from the traditional hubs.
The race is on. So to summarize, we've seen this comprehensive update. They're strengthening international alignment, standardizing accounting with IFRS 17, future-proofing against climate risk, and, critically, positioning ADGM as a major international reinsurance center.
So what does all this mean for you right now? Well, these changes are coming, and they're meant to enhance CRFR management across every single firm in ADGM. And stakeholders have until January 30, 2026 to give their feedback.
And that brings us to our final provocative thought.
It does, and it ties back to that explosive section on market conduct. In the paper, the FSRA explicitly asks how they should embed the fair treatment of customers into their broader principles for authorized persons. Now, those are the core principles that govern all financial firms in ADGM, not just insurance.
So you're saying this isn't just about insurance anymore?
I'm saying this strongly suggests that the cultural shift we've been talking about, greater consumer protection, stricter conflicts management, might very soon be applied across the board, from banking to securities to asset management.
That would be the true scope of this regulatory revolution.